Hello and welcome. I'm Jonathan Beale and this is the ASB Investment Podcast, a show that keeps you up to date on the market and helps you make smart choices with your investments. Today I'll be talking with Chris Tennent-Brown, Senior Wealth Economist at ASB, who I've chatted with before. We'll be covering what's been happening in the markets, including the Reserve Bank's recent rate cuts, what the government is focused on now that capital gains has been dropped, and of course, Trump's latest antics. These are entirely our own views. It's not investment advice, but we know plenty of experts at ASB that'll be happy to chat if you need. Chris, hi, how are you?
Oh, good, thanks. How are you going?
I'm good. I haven't seen you for a couple of weeks, and you've been going on about this Spitfire to people. And what's going on there? Have you bought a Spitfire or something?
Oh, I've bought a pile of parts. So at the moment, it's 10,000 bits sitting in a container. But if all goes according to plan, it'll be something I can fly around in a few years' time.
So your economists are known for being quite sort of level-headed and serious, and you're
not so much
building a Spitfire, and then you're actually going to get in it and fly it as well.
Yeah, this is one of those things which cracks me up. Internally, I don't laugh when I'm actually talking to a customer about this. But people often think, "Oh, you're really expert on this sort of stuff." When we're talking about investments, so what would you do with your money? And I just have this internal laugh and think, "You don't want to do what I'm doing with my money. I'm making a small fortune out of a large fortune by building a plane in my garage."
Good luck with building it. One thing I can categorically say and guarantee, I don't use the word guarantee ever in investment advice and investment planning, but I'm guarantee I'm never going to get in a Spitfire with you when you're flying it.
That's probably quite a safe strategy. But speaking of habits and things we've been up to, how's the record collection going? Any new additions?
Yeah, it is actually. I was been away for 2 weeks in work. I've been over in the UK, which I can touch on later maybe in the show. I think I got followed by Donald Trump. Everywhere I went, Trump seemed to be there as well. But I did manage to buy a bit more vinyl. Went to HMV, which is a lot smaller than it used to be, and used to be on every street corner, and now it's just sort of one in London. But I did buy some additional vinyl, and I'm a bit of a Bruce Springsteen fan, so I did buy a couple of Bruce Springsteen's vinyl. So I'm reliving my youth again, which is awesome. Awesome.
Nothing wrong with that. That's probably what I'm doing by making a plane in my garage as well.
Exactly. Hey, now I think the last time we talked, the capital gains tax had been kicked into touch. Everyone got quite animated about the potential for capital gains tax, and it got swept aside in the budget. Was anything else in the budget of interest that people should know about?
Yeah, I think the fact that the capital gains tax wasn't there made it a little bit of a lame duck. But there's still the usual traditional things that economists look at in a budget, like what a debt level is going to be like, what are the growth assumptions that Treasury are making for their forecast, etc. And on that front, this budget fell into the category that most of the budgets over the last 10 or 20 years have, is that it was pretty prudent. It ticked all the usual fiscal boxes, and there was nothing that really stood out as amazing or going to change the course of the economy. One thing that is quite interesting, I think it's is a good idea, is this well-being framework that the government's using just to frame up the budget and the priorities. It's a new process, and another little change the government made was, instead of having this specific 20% debt target, they've got a band, and both of those things seem like good ideas to me. No matter what side of the political spectrum you're on, New Zealand's got an amazing position that the government's running a surplus. That's been happening for a while now. Debt is around 20% of GDP, and this is at a time when big economies like France, Italy, UK, the States have got debt levels that are over 100% of GDP, so more than 5 times the amount of debt relative to the economy that we have. They can't get back into surplus. So it's really neat that we're in a country when the budget comes out, we're arguing about how should that surplus be spent, tax cuts or expenditure, rather than when are we ever going to get our books into order, which seems to be the stories overseas. So I'm quietly proud of New Zealand's fiscal position over the last few years, and this budget got the tick on that front from me.
And that's been many years of the government having a real focus on debt ratio. That seems to be very different to maybe what other countries have been doing.
Yeah, well, you'd think in places like Japan, they've simply given up caring when debt's over 200% of GDP. It's just remarkable. And so here that's been a focus for a long time now, and the Clark-Cullen government, John Key and the National Party, they had a real focus on this keeping the books in order. And the real big blowout for us has been the Canterbury earthquake at the same time or in the wake of the global financial crisis. That pushed our debt up. But still to really manageable levels compared to what we've seen the other countries around the world, and it's really good to see. It gives us plenty of options for the future as a country.
It was interesting when I was in London last week, and the papers, the TV, the radio. Like if you go into a pub and listen to people talking, everyone's talking about Brexit. But there's been it just seemed to be a little bit of a change where people are going, we're so over Brexit. We want to talk of things like healthcare, employment, defence, all those things that, everyone, for 3 years, people have stopped doing that in the UK. It's lovely living in a place like New Zealand where actually we talk about those other things and should we invest more in hospitals and education and stuff. It just shows what a sort of how lucky we are sometimes.
Oh, absolutely. And we're in a position that if the government of either party chose that they didn't need to be quite as tight with the purse strings, they can fund at really low costs. We've got a great credit rating because our debt's so under control. So we've got options to be able to deal with future challenges and problems. And whereas offshore, they're grappling with such major issues. So we've got a good bunch of choices here for sure. But for the economy, if we're not going to have capital gains tax as something to really grapple with and then be an election issue next time, I guess we'll see a lot more. Well, I'm hoping that we're going to see a lot more coming out from all the politicians about, so what are we going to do as a way forwards? What are some aspirational ideas we can have? And for Labour, this wellbeing budget and that framework was the first step along their journey towards how they'd like to frame up priorities going forward.
So not too much in the budget to affect sort of markets and people's investment, but certainly the Reserve Bank cutting interest rates was something that will affect people's investments and markets. So you've got a view, again, rates being cut. I should get that T-shirt, lower for longer. But
yeah.
What's your view on why the cut, firstly, and was it the right thing, and what does the future hold?
Yeah, well, it's funny, isn't it? Because I've just been talking about how healthy the government books are and how well things are going relative to offshore. Yet here we are, the Reserve Bank's cutting rates, which sounds like the economy's got a problem and it needs lower interest rates to help with. And really what is going on there is that, again, we're going through a soft patch of growth. Our economy's slowed to levels that economies around the world would love to have, when we're growing closer to 2% rather than the 3% or more that we've had in the past. But as a consequence of that slightly softer growth and there's a real lack of inflation pressures within the economy. So the Reserve Bank does have the capacity to cut the official cash rate to try and keep the economy going as well as it can through this softer patch. And the other thing I think we'll be watching over the coming months is, do businesses, now that they've got that uncertainty of the capital gains tax behind them, does their confidence pick up and the economy gather a little bit more momentum? What does all this mean for investments? Well, term deposit rates have dipped a little bit over the last month or so. Mortgage rates have dipped a bit. So, yeah, the lower for longer T-shirt, you could just about get a tattoo now. It seems like it's going to be low interest rates for such a long time. And we think the Reserve Bank could likely actually give another cut to the official cash rate over the rest of the year. Meanwhile, the share markets continues to go well. We had a good month for New Zealand shares through May, a little bit jittery over the recent weeks with a bit more Trump stuff that we can touch on. But overall, that driver that we've talked about for such a long time now, low interest rates, supporting equity markets, companies that are delivering on their earnings going well. That's been the theme we've seen in the New Zealand share market and in the New Zealand fixed interest market. We've touched record lows for our 10-year government bond yields. They're well under 2% now, so incredibly low interest rates in the economy.
But you talk a little bit about this is the new norm, and if you like the period we've seen previous to this with high interest rates was actually abnormal, and this is just normal. Do you want to talk a little bit about that?
Yeah, I think one of the things which is hardest for people when they're trying to work out normal is we normally have some sort of average going on in our heads or some sort of gut feel based on our experiences. And you and I are knocking around the half-century mark and quarter of a century of work experience. So our gut feels hopefully pretty good for thinking what's going on in markets. But in the interest rate space, there's been one thing that's been going on for our entire careers, and that's interest rates falling. And now they seem to be about as low as they can be. But my view is that this is more normal than what we worked through. The inflation in the 70s was unusual. The high interest rates that central banks use to get it into check is the right thing to do, but that's actually unusual in terms of the interest rates the economy has to persevere with. And so for me, this lower growth, low inflation, low interest rate environment, I think it's going to be around for a long time. And we're thinking that things like the official cash rate, even when it does get lifted, it'll be into the early twos, not back up to the 6 to 8% range that we had prior to the global financial crisis. So lower for longer. I'm reluctant to say this is going to be the way it is forever. The world keeps changing, but I think that this is the way I'm thinking that the next 5 years is going to look, is that these very low interest rates are going to prevail.
I took a picture of a bank when I was in London because I had a big poster out the front advertising their best rate, and it was 1.3% with like these two people smiling behind in the picture, happy with their 1.3%. It's bizarre, isn't it? Really, absolutely bizarre.
Yeah, and it's really the level that interest rates have fallen to in other parts of the world aren't even really covering the inflation that we would expect. I mean, our inflation is in that 1 to 2% range. So if you're getting 3% on a term deposit, you're keeping ahead of inflation. But for a 10-year government bond in New Zealand now yielding 1.7%, it's barely keeping pace with inflation. And that's what term deposits and all sorts of investments are like in other parts of the world. Cold comfort for investors here. They just want to generate a return and make some income for themselves. But it's harder in this low interest rate environment than 10 years ago when you could get really good returns just from a term deposit.
And for the people listening, explain maybe why does the Reserve Bank want inflation? It sounds like sort of counterintuitive, but why do they want a certain level of inflation?
Well, it's at the end of the day, it's just a number. No inflation is really good if you're retired and you've got a bunch of savings. And a lot of inflation is really bad because it really distorts investment decisions. People are really reluctant to invest if they've got no idea what things are going to cost in the future. So the 1 to 3% range that we've got here is just a number. You could call it a Goldilocks number if you like, but it is just a number. So that focus on that 2% midpoint is our thing. It's similar around the world. The Reserve Bank of Australia's got a 2 to 3% target range and would expect them to meet it. But they are just numbers. You could argue that they could be targeting 1% and all sorts of things. And in that vein, I think with inflation under control, I quite like the idea that, well, what other things should the Reserve Bank be focused on and what other tools have they got? In recent years, the Reserve Bank's got an employment target that it thinks about when it's managing monetary policy. And of course, we've seen the Reserve Bank take a pretty active role in lending restrictions over recent years as well. So the inflation target is just part of the mix, but it is just a number that the government and the Reserve Bank agree on. Okay.
And then in May, we saw quite a bit of volatility in share markets. We've seen a sort of a bounce back recovery in June. You've been saying for a while now that the fundamentals are really good. Why do you think we started to see some volatility in May?
I think people are really responding to the growth threats that they see coming out of some of the trade dispute between Trump and China in the first instance. But he's stepped it up through the recent months. Mexico was in the spotlight, and fairly unexpectedly, and in the way these things go with Trump, it's announced with a tweet, and the response is announced with a tweet, and the problem appears to be solved with regard to Mexico right now, and then with China, it just seems to be getting worse and worse. So markets haven't liked that. At the same time, we've had an incredibly encouraging interest rate backdrop, but the Trump stuff has rattled people a bit, I think, and then through June, we've focused on the positives a bit more, and US share markets, for example, have largely recovered. New Zealand's share market through this time marched to its own tune, and we posted a 1% gain in May, while other markets were down 5% or more. So, we've been amazingly resilient to some of this stuff, but it has been rattling global share markets, that's for sure.
It's strange because you hear all this record high, and I think sometimes that people see that as a bit of a negative potentially. But if you think about where we are in the cycle, low interest rates, good growth globally, there's actually no reason why there's going to be can't be another record high, and actually doesn't mean it's going to go backwards just because we're at a record high. Yeah.
Yeah, well, the thing I always think about that is, no one likes paying too much for something. But what I'd like to see is a record high the day I need to withdraw my investment. So I actually want to see plenty more of them over my investment life. And what I've learned in my 25 odd years of trying to help people with this sort of stuff is when you're seeing record lows, most people don't have the guts to go, oh, now I'm going to really get into it. They're just worried and nervous and don't want to touch any risk with a barge pole. So I think we've got to be really careful about these ideas of trying to time when to get in or when to get out of the market, and particularly getting scared off by record highs. I think hopefully we'll see many, many, many more of them over the rest of our investment lives.
I must admit, I've been really encouraged and pleased when I've been going around the country speaking with customers and asked if they've listened to the podcast, and a lot of them have, which is awesome. So we're becoming little celebrities in our own minds. But the word I hear a lot is comfort. And it's lovely to hear that people are listening to these going, actually, I'm getting some comfort, because there is so much noise and so much information readily available today that actually, so you just need to cut through it, don't you, and go, actually, why have I invested my money? What are the outcomes I'm trying to get? Am I achieving what I want to do? And it's always going to go up and down. But understanding why and what's behind it, I think, is always the key part to investing money.
Yeah, and one of the things I've noticed, again, talking with people is this feeling like, oh, this time's different though. And hey, maybe it is. But I think one of the things which is feeding into people's thinking is we get so much information now. Like we do literally get to see what Trump's thinking a nanosecond after he's thought it, because it arrives in a tweet. And that's pretty unusual. I mean, when at the start of my career, we used to have to ring up the dealing room, and then they would ring up the dealing room in Asia to see what was going on in the Asian markets on any given day. Now we can all be watching it live on our phones. And if you're a 20-year investor, you don't really need to be checking your phone every 5 minutes for the latest news to work out what to do next. But there's a temptation there, right?
Yeah, exactly.
So I think the amount of information we get and the way we get it now can be quite rattling. And this is where I think it's really important to focus on the long term. Like with Trump, people know I'm not a huge fan, but we need to brace ourselves for at least another couple of years of tweeting updates about how the world should be.
Well, it could
run.
be 6 years.
Yeah, and it could be. I won't rule it out. And that's the way the world's going to be. So we have to focus on our own game. For you and I, hopefully we've got 10 or 15 years before we retire, and maybe 40 years of being an investor. So there's going to be plenty of stuff that we don't like, and maybe there'll be something even faster than tweets that we get the bad news from in the future. But we do need to focus on the long game, and the ups and downs. You certainly need to ride them out a bit.
I don't know if this is true, but I was in a workshop today, and someone said the life expectancy of someone born today is 115 years. Like, that's just ridiculous, isn't it, really? And so I think people are just going to live longer, and people who retire today at 65, I think life expectancy is about 91. So your investment you've got and the income you're going to draw has to actually last a lot longer than maybe 20, 30 years ago. And so you have to start thinking about investing money in different things.
Yeah, well, I'd said to my mum and dad that their investment goal should be to bounce the cheque to the undertaker, and when they retired. But gee, if you're 65 and you might live to 115, that's a complicated process.
That's well, yeah. Hey, now in the next few weeks, what should we be looking out for? What's coming up that our listeners should be thinking about?
Well, in our case, we'll be watching the local economic data. We've got growth figures coming out, and I think financial markets will be really trying to form a view of, hey, is the Reserve Bank going to cut interest rates here again? How much lower can rates go here? But offshore, gee, it's going to be an interesting few weeks because Trump's wound a few people up over the Twitter over recent times. And we've got the G20 summit in Japan later on. So, this is where a lot of the world leaders will be, and Trump will be presumably meeting with the likes of China. Putin should be there, and Merkel. A lot of the people that have been agitated in all these recent issues, and so markets will be looking for some positives or negatives out of that, and I think that'll really set the tone. Just carrying on from what we've seen in May, when people are really looking for signs that this global trade situation is going to improve, and so that meeting will be really big for that.
He seemed to upset a few people on his trip to UK and Ireland. He said he upset the Welsh by
Prince of Wales.
Prince of Wales with an H.
Yeah, that was special.
That was special. I think Ireland, he was talking about the borders, or
yep, we've both got border walls, and that's interesting as well. So, global politics is different to what it's been in the past, and so this meeting, when they all get into one room, will be fascinating.
It was when I went for I was talking to someone earlier, but I went for a run when I was in London and got up early and ended up at Buckingham Palace and took a picture of the Queen because the flag was flying, and then ran down the Mall, and there's all these big British flags and American flags because Trump was arriving in the afternoon, I think, and then I ran a bit further, and then you've never seen so many police officers with guns. It was just absolutely outrageous, like how things have changed. I used to go around London and be police with truncheons, and now they've got sort of semi-automatic rifles and stuff. How the world's changed in sort of 20 years is quite ridiculous, really. But there was a lot of people protesting about Donald Trump. Yeah,
not that you'd see that in all the fake news, I guess. But hey, watching all of that stuff, unfortunately, is what keeps me busy for the rest of the month. And what about in your world?
Oh yeah, it's been a busy time. The trip to London was fascinating. We're looking at how we bring digital advice or robo-advice to customers at ASB. So we've been talking to a number of parties over in the UK, which was fascinating. So they're probably 5 years ahead of us in robo-advice. So we're looking at how we learn from that and how we do it slightly differently here. So that was fascinating. I think last time we talked, I mentioned after the horrific shootings in Christchurch what we'd done with some of our fund managers, namely BlackRock, and our letter to Facebook, and then some exclusions we were looking at. So I suppose in a positive, we got a response or an acknowledgement from Facebook to our letter, which was probably more than we expected. So it's nice to know that actually it landed on someone's desk and someone did something about it. So that was positive. And we took a recommendation to the investment committee to exclude companies that manufacture to sell assault weapons to civilians. So that was approved. So by the end of June, we'll be out of companies who do that. So, which I think is the right thing to do. And we've had lots of customer feedback that that's something they would expect a company like ASB to do. So I think, as we talked about before, that's the power of having very large fund managers like BlackRock and Vanguard and State Street that we can use and leverage, and the ability to move quickly and sort of the inbuilt focus on making sure we're doing the right thing by the customer, and the values of the organisation like caring and integrity come through really strongly. So it's a good thing to do, keeping us busy, but it's the right thing to do.
Yeah, nice to hear that we have a voice and it's made a difference. And hopefully when you're in the UK, you didn't go and see any robo-economists. No, but maybe that's the next thing we should be looking at. Hey, Chris, as always, been lovely chatting to you, and good luck with the Spitfire.
And I might pop round and have a look at it, but I'm definitely not getting into it. But thanks again for your insights and your time. I really look forward to next time speaking to you again. Thank you.
Thank you.
Thanks for joining us today on the ASB Investment Podcast. If you have any thoughts on today's episode, or if there's anything you'd like us to discuss on future shows, please fire your suggestions through to podcasts@asb.co.nz.